This is Kenya News Update today. A single number, 39%, just vaporized $357 billion from the world's most valuable company. Microsoft's stock just had its worst day since 2020, plunging 10% in a single session. But here's the twist. The company actually beat earnings expectations. So why did the market panic? And what does this tell us about the trillion-dollar AI war that's reshaping our digital world? You're about to see how a tiny miss on a single metric can trigger a financial earthquake. Meet Microsoft's cloud business, Azure. It's the engine of the company's future, the platform powering the global AI revolution. For years, its growth has been staggering, a rocket ship that seemed unstoppable. In the last quarter, it grew by 40%. This quarter, it grew by 39%, that's right, a 1 percentage point slowdown. And that tiny dip was enough to send shockwaves through Wall Street, wiping out a market cap larger than the entire economy of Kenya. But here's what nobody's talking about. On the exact same day, Meta, the parent company of Facebook, also reported massive AI spending. Their stock jumped 8%. So why the opposite reaction? The answer lies in a secret internal decision. Microsoft's chief financial officer, Amy Hood, revealed the shocking truth. The company chose to prioritize its own in-house AI needs, like its Copilot software, over allocating data center capacity to paying cloud customers. They sacrificed short-term cloud growth for what they believe is a higher margin, long-term AI advantage. It was a conscious choice. And then, something even more revealing happened. Analysts rushed to decode the move. Raimo Lenskau from Barclays said investors are too focused on Azure's growth number. He pointed out that with a business this massive, the law of large numbers makes acceleration nearly impossible. Meanwhile, Mark Mowerdler from Bernstein defended the strategy, saying management made a cognizant decision for the company's long-term health, not to pump the stock price this quarter. But here's the part that will blow your mind. Despite the historic crash, major banks like Wells Fargo are still screaming buy. They rate the stock as overweight, citing Microsoft's early AI lead and strong incumbent position. They see this not as a failure, but as a strategic pivot in a hyper-competitive market. The stakes, nothing less than dominance in the next era of computing. This is more than a stock story. This is a seismic shift in how we value technology giants. For years, cloud growth was the undisputed king. Now, the market is struggling to price a new reality, the immense cost of the AI arms race. Microsoft is betting billions that owning the most advanced AI tools internally will pay off more than renting out the raw computing power. Some analysts call it visionary. Others see a dangerous gamble. The tension is palpable. A $357 billion question hangs in the air. Did Microsoft just make a $1 trillion mistake or a $1 trillion masterstroke? The company chose its own AI future over immediate customer satisfaction. In the high-stakes poker game of big tech, that's an all-in bet. So, what do you think? Was this a panic over nothing, or a warning sign for the entire AI boom? Drop your take in the comments. And subscribe to Kenya News Update today for more breaking insights into the forces shaping our global economy.